Hey everyone, welcome back. Today on The Explainer, we're doing a deep dive into Novavax's massive strategic pivot. We're looking at what is honestly a fascinating turnaround blueprint. We're going to see exactly how a company transitions away from being just a single product pandemic stock and attempts to transform into a highly diversified, long-term biotech player. Let's get right into it. That brings us to the ultimate question, doesn't it? How exactly does a pandemic darling survive when, well, the pandemic ends? It's kind of the core puzzle we're solving today. How does a company completely reinvent itself, stabilize its wildly fluctuating finances, and pivot to a brand new future after its primary massive growth driver essentially disappears overnight? Okay, so here's our roadmap for this turnaround blueprint. We're covering 5 key areas today: Novavax's second chapter, the Matrix M strategy, their Q1 2026 financials, liquidity versus debt, and finally, Wall Street's forecast. Let's hit it. All right, kicking things off with Section 1, Novavax's second chapter, moving beyond pandemic-era volatility. So this new chapter was actually formally introduced at the 2026 JP Morgan Healthcare Conference. It signaled a really definitive corporate shift away from relying on the unpredictable seasonality of COVID-19 vaccines. Novavax CEO John C. Jacobs put it perfectly, saying this company is no longer about one product or one season. It's about building a sustainable engine for value creation built on technology, discipline, and long-term partnerships. The big takeaway for you here: management is actively and aggressively stepping away from funding their own commercialization. Instead, they're leaning heavily into a much leaner, highly disciplined, partner-driven model. Moving right along to Section 2, the Matrix M strategy, monetizing a differentiated vaccine technology platform. Now, this strategy is basically the fundamental engine replacing their old reliance on that single COVID-19 product. So what exactly is Matrix M? Basically, it's a proprietary saponin-based adjuvant. Or in much simpler terms, it's a chemical additive technology that enhances immune responses across multiple vaccine platforms. And the best part, it actually lowers the amount of antigen required and cuts manufacturing costs. This is literally exactly what external pharmaceutical giants are eager to license right now, simply because it makes their own vaccines work better and cost less to produce. It's a real win-win. And you can see that playing out with these key partnerships, which are generating critical non-dilutive capital. This brilliantly illustrates their new diversified revenue stream. First off, you've got Sanofi taking over commercialization and providing a co-exclusive license. That's a deal that's already generated upwards of $800 million over the past 18 months. Huge, right? Then you have this massive new agreement announced in early 2026 with Pfizer, licensing Matrix M for 2 infectious disease targets. Add in the Serum Institute collaboration on a malaria vaccine, plus multiple new material transfer agreements, or MTAs, exploring oncology and other diseases. So the absolutely crucial point is right here. Partners can now evaluate Matrix M in over 30 unique fields of experimentation. This targets over 50% of a projected market that actually exceeds $100 billion. Wow. Why does this matter to us? Well, because these partnerships allow Novavax to tap into massive global markets and harvest royalty and milestone payments, all without funding those incredibly expensive late-stage clinical trials themselves. It's a significantly lower risk path to revenue. All right, let's dig into the numbers with Section 3 Q1 2026 financial reality, tracking the pivot through hard financial data. Okay, so we understand the strategy, right? But we really need to track this pivot to objectively measure if this turnaround is actually working on the balance sheet. Now, what's super interesting here is the dramatic year-over-year shift. Total revenue dropped from $667 million in Q1 2025 to just $140 million in Q1 2026. But hold on, that massive drop is actually deceptive. You'll notice that Q1 2025 was heavily inflated by $603 million of non-cash contract closeouts related to old advance purchase agreements. What's far more indicative of their new strategy is the growth in licensing and royalties. That segment jumped from $45 million to $97 million, perfectly reflecting the success of their new partnerships, including a $30 million upfront payment from Pfizer. Next up, we need to look at what they're actually spending. Total operating expenses show a very meaningful drop here. Combined R&D and SG&A expenses fell from $137 million in Q1 2025 down to $124.3 million in Q1 2026. This really shows how Novavax is honoring its promise of financial discipline. They're successfully cutting internal costs and streamlining their infrastructure as they hand off commercial activities to partners like Sanofi. And this brings us to their explicit path to profitability. Management has outlined 3 super clear steps to navigate the next couple of years. Step 1, they absolutely must continue to streamline operations and reduce those internal costs. Step 2, leverage those milestone-driven cash inflows from partners like Sanofi and Pfizer to fund operations. And step 3, the ultimate goal, achieve non-GAAP profitability as early as 2028. Get this, they're even targeting bringing their combined expenses down to between 150 and 200 million by 2028. That would be a massive 50% reduction from 2025 levels. Which perfectly transitions us to Section 4, liquidity versus liabilities, balancing cash reserves against structural debt. I think this encapsulates the core tension of evaluating this company right now perfectly. We have to contrast their near-term liquidity with their historical baggage. So on one hand, they have a really solid $790.3 million in cash equivalents and short-term investments as of Q1 2026. But on the other hand, you absolutely have to factor in their heavy liabilities. We're talking $291 million in long-term convertible debt and negative shareholders' equity of roughly $144.8 million. So they definitely have the cash runway to operate the business today, but they're still carrying the very real weight of past financial struggles. And the immediate, tangible result of that tension is this number right here, negative $9.49 million. That was their Q1 2026 net loss. So the crucial takeaway is that while this net loss is vastly improved from the massive hundreds of millions in losses we saw in past years, the core business is unfortunately still slightly in the red. They just aren't consistently generating positive operating cash flow entirely on their own yet. So, where exactly does this leave the market's perception? Let's explore Section 5, Wall Street's forecast. Analyzing analyst predictions and market expectations. We're going to analyze analyst predictions to see how financial experts are actually interpreting these mixed but undeniably improving financial signals. According to the data from the explainer sources, the average Wall Street analyst currently projects a 12-month price target of $17.50. Based on trading prices at the time of the report, that represents a massive 97% potential upside from current levels, literally almost a double. Furthermore, when we look at the actual recommendations driving that number, they are overwhelmingly bullish. It's evenly split 50-50 between strong buy and buy. Analysts offering these targets are very likely factoring in the huge potential upside of that new Pfizer licensing deal, the ongoing Sanofi royalties, and of course the massive cost reductions taking effect across the entire company. But hey, objective anchoring requires us to balance this optimism with the actual reality on the ground. Take a look at the risk factors to consider here. First, the forecast return on equity is considered quite weak at negative 13.9%. Also, strictly quantitative rating models actually suggest a hold rather than a buy. They note that revenue remains highly inconsistent quarter to quarter, and the company does still experience operating cash burn. Remember, this is a turnaround. It's a work in progress, not a stable, predictable compounder just yet. Which leaves us with this final kind of provocative thought for you to ponder. With roughly $790 million in liquidity secured, but actual profitability still projected to be years away in 2028, is Novavax's turnaround fully priced in? You really have to weigh that secured cash runway against the multi-year timeline to profitability. It's a fascinating situation, and I highly invite you to keep a close eye on how this turnaround blueprint unfolds. Thanks so much for joining me on The Explainer today, and I'll catch you in the next one.